you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and here with me today is Luke Hickmore, manager of the Aberdeen Strategic Bond Fund. Hello, Luke.
Morning.
So we've have some movement in the bond market this week. 10-year gilt yields rose to a 5-week high of 1.71%. German bonds came up, the 2-year gilt yield also came up. Is this the beginning of the end that we've all been waiting for? Is it just going to be yields up and prices down?
I'd love to say yes, but no. I feel we're in a low environment for yields for a long time yet. Inflation's low, it's going to stay low for at least another 2-3 months. You've got money being pumped into the bond market by the QE from the ECB every single month, and that goes on right through next year. I'm afraid our view is we stay with these low yields for at least the rest of this year. Now, there'll be volatility around that. We've got a few events coming up in the UK, for example, in the next couple of weeks. We will see some volatility, but it's a tough place to find returns in government bonds. And I guess for us in the Aberdeen Strategic Bond Fund, we've got a wide investment field we can look at. These aren't, fortunately, the only things we have to do.
You mentioned there, though, that we're going to remain in a low yield environment. I suppose that takes the pressure off how you manage money in an environment where prices are falling, but low yields still mean low returns, and you're looking at the total return.
Absolutely.
So where can you find value for the investor then?
I think that's a really good point. Everybody's been playing the carry trade for the last 5, 6, 7 years. It's all been about trying to increase the amount of yield you can get from your investments. And in particular, this is what the ECB wants us to do. They want us to chase into higher and higher risk investments to try and get that carry. And you're right. It's going to dissipate at some point, so you have to think further and further afield. Now, I was looking this morning, you can buy Italian bonds versus German bonds today for around about 1.3% extra. If you look at every single BBB bond in euros, there's 5 of them that give you more than that. And they're more risky than the Italian sovereign. So there are still things we can do. We think that spread can compress a lot. We think Asian investment grade's really interesting at the moment. We've been investing more in the UK where the yields are better than they are in Europe. And we've been occasionally looking over in the US as well. Ideally, you want some events to happen so things could get cheaper. Last year's fall in the oil price was a great opportunity to pick up some really good quality businesses at depressed levels. And when you can find those things, that's a godsend for a strategic bond fund manager. Ideally, we do see some more volatility as we go through this summer, and that gives us more of a chance to look for things. But on a consistent, ongoing basis, it's about getting the mix right between your investment grade and your high yield bonds, and possibly a little bit more towards high yield just at the moment. Just to play that carry trade for the last few months, I think that's possibly where you get a little bit of return left.
And you mentioned their risk, and in particular in sovereign bonds. At what point do you say, actually, this is too risky for the return being offered? Because, last year you could actually get more return on an Apple bond than you could on an Italian bond, when Italy looked like quite a difficult place to be, and Apple is, one of the most cash-rich companies in the world.
I've got a very different view of Apple, but that's a personal problem I have with the company. Absolutely, and I think it's an important one that, how far can this yield drop go? And in Germany in particular, this could be 0.2% negative 10-year yields. That's really where the floor becomes important. And I think, that can be the case autumn this year maybe. At that point, I'd start to get really worried about being invested in government bonds. When you've got a negative return right the way through the curve, it's really difficult to make any money out of that. And actually, even then going into credit that spreads over those government bonds that are already negative, difficult again. There are 80%, I think, of investment grade bonds in Europe which yield less than 1%. Yeah. This is not a great landscape to make a lot of money in. So you look further and further afield. But the risks are rising. You have to be very aware of that. But it's going to take quite a lot for those yields to change dramatically. Nobody sees, and we certainly don't expect a big pickup in growth in Europe. Certainly don't expect a big pickup in inflation. We get this oil price drop out in the next couple of months. But there's a lot of spare capacity around in the world. You can't look at a single country anymore and think about spare capacity. You've got to think about emerging markets and developed markets, and there's a lot of spare capacity around. And I think those disinflationary forces could be with us for a while. So You're nervous about levels, but you kind of need to be in it.
I can't let you go without picking you up on that Apple comment, I'm afraid. So why are you not happy with Apple?
Oh, I've always been an Android man, not an Apple man. But there we are. That's just me. From a company perspective, they're perfectly good, sound quality credit, but I don't like their products.
Luke, thank you very much.
Thank you very much.
This is Emma Wall for Morningstar. Thank you for watching.